Good afternoon, everyone. This is Jeannie from the Above Board Chamber, and I want to welcome you to our program today to talk about our economy and how we are going to recover. We're very excited to have so many of you with us today. We have two rock stars that they're going to talk about the economy and what's going on and what could happen in the future. And without any mixed messages, we're going to get some facts, which is really, really important in today's world to know what's going on. I'd like to take a minute and thank each one of our sponsors. And I'm going to tell you a little bit about each of our sponsors. Our first sponsor is Theo Etzel. He's the chairman of the board for Condition Air and author of the book, Invest in Your Heartbeat. At Condition Air, their goal is to keep your home and business comfortable year-round, whether you're looking for routine or air-conditioned services, repairs of your home, installation of new systems, large commercials, or anything in between. They are located in Fort Myers, Naples, Sarasota, Cape Coral, and surrounding areas. And they also put my air conditioning in, so I know they're good because I'm cool. Our other sponsor is Michael Wynn. He's president of Sunshine Ace Hardware. Michael oversees 12 Sunshine Hardware locations from Marco Island to Tampa, Florida. Sunshine Ace Hardware is one of the largest family-owned home improvement and outdoor recreation retailers in Cuyler, Lee, Charlotte, and Pinellas counties. With a variety of helpful services like rod tips, repairs, and free deliveries, they are much more than just a great hardware store. It's been that way since 1958. That was before Michael was born. So that's very exciting, Michael, that your family's been doing this for so many years. Our other sponsor is Connie Ramos-Williams. She's the president and CMO of Conrick PR and Marketing, which is one of the leading public relations marketing advertising agencies in Southwest Florida, serving over 100 businesses, clients in the region and across the United States. Campaign, interactive public relations programs, marketing, development, consulting services, advertising campaigns, media buys, creative writing, and designs. She also does digital marketing strategies, website development, crisis communication, strategy, implementation. The firm serves clients in many industries throughout Southwest Florida and the country. Where am I now? Conrad is a recipient of multiple image awards from Southwest Florida chapter of Florida Public Relations Association as just one place that she gets her awards from. She gets them all over. She also does our website for the Above Board Chamber, and she's helping us put on this website today, along with doing all of our press releases. So thank you, Connie. Our other sponsor is Brian Riss. Brian Riss is not with us today. He is on vacation, which he deserves. Brian's executive chairman of StormSmart, which is one of the largest manufacturers and installers of code-improved hurricane protection products in Florida, with more than 80,000 customers in Florida, the Caribbean, Mexico, and Guam, since opening its doors in Fort Myers in 1996, and we know why Brian needs a vacation. Kevin Lorraine is another one of our sponsors. He's the president and chief executive officer of Quest Resources, the division of Castleton Capital, with 5 locations throughout our country. Kevin is also the mayor of Sanibel Island and is currently running for the seat on the Board of County Commissioner in Lee County, and we wish him well. Kevin, you have my vote for sure. Scott is our last sponsor, Scott Lehman. He's the president of Trinity Janitorial Services, which is a full-service janitorial company. They offer day porter services, including general maintenance, sanitizing sprays, complete floor care services. Their products are all natural and EPA approved to sanitize the 99.9% of virus, including our favorite one we have right now. Every cleaning sanitizes your home and facility to CDC guidelines. Their core values are the backbone of Trinity's janitorial services. That was a lot of words, but we have sponsors that do a lot of things, so we're excited. We're excited to have each one of them. We have a wonderful committee. We wanted to thank Theo Etzel, who we just mentioned, Michael Wynn, Vicki Tracy, who's the chief operating officer at Gulf Coast International Properties, Connie, who we just met, and Ursula Fall she's the vice president of business development at Bingham Jewelries. So that is a lot of stuff to say. So we're excited to have each one of you, and we appreciate your sponsorship for our program. So I think we're going to bring Michael up now.
All right. Thank you, Jeannie. So it is my honor to be able to introduce our MC for today's economic discussion, Mr. Nabil Hanano. Mr. Hanano is a chartered financial analyst and is vice president and associate portfolio manager of T. Rowe Price Group's Global Focused Growth Equity Strategy. He manages over $15 billion in assets, primarily for institutional investors. His strategy mandate is focused on growth, investing in all sectors, market capitalizations, and countries across the world. T. Rowe Price overall managed approximately $1 trillion in assets as of this past March. And so we are very privileged to have his experience in global financial markets to ensure that we gain the most from our time today, understanding what the economic recovery will look like in the coming years. So please join me in giving a very warm virtual welcome to our MC, Mr. Nabil Hanano. Welcome, Nabil.
Nabil, is there anything else you want to share about yourself?
Right now, the only thing I could think about is the 2-year-old banging on my door. But no, excited to be here, excited to have this conversation with James and share our views of where we are within the current state of the pandemic. What are our thoughts about the recovery going forward, and where are some of the best opportunities to look for in investing? So I'm happy you had me here, and thank you. This was a great event.
Nabil, tell us something that you think that's going on in the economy right now that's shocking to you.
I would have to think it's really, when I think about what's happening right now, we're actually living in the future. I think the pandemic has pulled forward a lot of the trends that we were seeing over the next 5 to 10 years, and it's pulled forward about 5 years. So there's a lot of structural changes that are happening. I think one of the things I want to get into discussion with James is there's a lot of digital tools that are really creating increased productivity and efficiency across vast swaths of the economy. And one of the most interesting dichotomies I think that's happening is we're living in this period of abundance, of too much. We have too much energy, too many things, too many free services. And actually, you think about, you would have thought that was a happy environment to be in. And when you look at the state of the world where we are today, too much of something can be actually a bad thing. We're living in a period of low growth, low inflation, and a lot of that is driven by the disruption in a lot of these technology companies, and a lot of the companies that are thriving today, particularly in the pandemic, that's accelerating this disruption of traditional industries. And so I think one of the most interesting things that we're going to have to deal with over the next 5 years or so is how is all of these digital productivity tools changing the sustainable growth of the economy, and what does that mean for a lot of traditional sectors that aren't participating and actually being severely impacted? I think that's one of the biggest questions we're going to have to ask, and it'll dictate the pace of recovery for various parts of the economy.
Well, that's really interesting, because there's so many people with businesses that need to know what to do going forward. So having expertise like you and my son, it's going to make it a whole lot easier for us to understand what we need to do. I think we just got James in. So Theo, I think you are up.
Thank you. I am very pleased to be able to introduce James today. But before we get to that, let me just go over a little bit of the agenda so people have an idea of the pace we're going on. As soon as I do get through with a formal introduction of James, and I certainly want to thank him on behalf of everyone attending that he has made himself available to be here today, we will go right into Nabil and James chatting. James calls this a fireside chat. That concept is hard for me to wrap around my head around in Naples, Florida in the middle of summer. But we will enjoy a conversation on the economy and good discussion. And I would tell you that from 4:15 or so till close to 5 o'clock, we will be in that discussion and listening attentively, but also please feel free to go to the question and answer tool at the bottom of the screen, fill out questions, and between say 5 and close to 5:30, they will field these questions and try to answer as many as possible. So I encourage you, and I know Nabil will remind you to do that as well, but feel free to submit those. And so I would like to go ahead and officially introduce James and tell you that James Sweeney, Credit Suisse Chief Economist and Regional CIO for the Americas. Mr. Sweeney manages a 35-person economics department that spreads worldwide. His written topics focus on the global and US economies, particularly on global industrial production and the workings of the global financial system. His work appears regularly in major international financial media, and James travels extensively to meet clients and policymakers. James is a member of the Credit Suisse's Zurich-based investment committee, which determines investments for some of the firm's more than 800 billion in assets under management. He is a member of the Americas Operating Committee of the Global Markets Division and the Americas Pension Investment Committee. Previously, James held roles including head of fixed income research and chief fixed income global strategist. He joined Credit Suisse in 2000, having previously worked as a political speechwriter. He holds a Master's of Science in Economics from the London School of Economics and a Bachelor of Science magna cum laude from Florida State University. James is a member of the Council on Foreign Relations, the Economic Club of New York, and the National Committee on United States-China Relations, something that obviously is in the news a lot these days. So it is my pleasure to welcome James to our discussion today. Thank you.
All right, well, thank you. Nabil, you wanna kick us off?
Yeah. First of all, I'd just like to thank Jeannie and the above board for putting together this great event. But before getting started, I just want to put out the disclaimer that the opinions expressed today by James and myself should not be considered as advice or recommendations to investors or potential investors and are not supported by either of our firms, Credit Suisse or T. Rowe Price. So with that, I think we could get started. So James, without a doubt, the most important question that I'm dealing with, that everyone's dealing with, is when do we get back to normal, both from a societal and economic perspective? The driver of a return to normalcy obviously hinges on the trajectory of the virus. I think it would be helpful to start off this conversation with how you're thinking about the trajectory of the virus over the next 6 to 12 months, particularly with the resurgence that we're seeing across various parts of the country.
Yeah, sure. And we have been tracking the data on contagion all along very closely. And it's important to realize that this is all over the world. So we need to draw the lessons of the data, we have to look at the data everywhere. And what the data everywhere show is that the right kinds of policies and the right kinds of measures can control outbreaks, but the outbreaks are local. And really every place around the world is at risk of an outbreak if they don't do the right things. And so what we've seen is an interesting sequencing where the virus spread first out of China to the places that you would expect had some of the most flow of people with China. So that was first immediately in Asia, but then in places like London and New York and Milan, where you do have a lot of traffic back and forth to China. But now you've had your first wave in a lot of those places. You've learned how to respond in many cases. Some countries have had extraordinary success, really including China, in keeping infections very low. And even in New York, which was the worst infected in the US, you've had a very significant decline. But we in the US have stepped off some of these measures a little bit, and we have seen a sharp increase. And interestingly, if you separate the states that started reopening early in early May and before that versus the ones that started later, there's a very clear pattern where basically the ones that started earlier are seeing a more extended increase in infections. Troublingly, the ones that reopened later are now starting to see a pickup in infections. And even in the New York area, we are now starting to see some signs of increased infections also, particularly in New Jersey. So, it really looks like masks and social distancing measures are very important. And it also looks like if infections are below a certain level, tracing and tracking and these sorts of things can keep the virus under control if it's done well. And it's being done well in a lot of places, but the US is now in a situation where there's enough of infections that you can't really track and trace with great effect in some of these places where there are serious outbreaks. And that's a big problem, and it's leading to revisions of the economic landscape, by the day.
Yeah, I think it's kind of clear just within the past 2 weeks, you're starting to see a fall off in consumer traffic and credit card sale data. I mean, we've been spending a lot of time focusing on the therapeutic aspects, the timeline for a vaccine. And really the way that this ends is we have either herd immunity, where some people think you need at least 70% exposure of the population to stop the virus, or a vaccine. The interesting thing with the vaccine approach is it normally takes a decade to do a vaccine, and we're shrinking that time to 9 to 12 months. And so it's never been done before. A lot of the initial data has already been positive. We'll see how it works in larger phase 3 trials that are starting underway now. I think some of the bigger trials are actually being done in Texas and Florida. And we'll find out about those in probably call it towards the end of this year, and definitely by Q1 of next year. The way we think about it is probably within 6 months, we're going to have a clear view of when we're going to be past the virus. It's unfortunate what's happening right now. I kind of think about it as like a college group project where you have like 1 or 2 people that are really focused on doing the project, and then you have a couple other people that don't really care. And that's kind of like the collection of states in the US, where you have to have everyone buy into this strategy of social distancing and masks. And without that unified buy-in, we're not going to get rid of the virus. And so I think it's going to be here with us to stay for the next 6 months, to 6 to 8 months until we have a vaccine. The interesting thing to your point about the cases rising in New York, one of the things we've been working on is obviously we're not capturing all the cases with the testing, but there may be 20 to 30% already infected within at least the greater New York metropolitan area. And so if we see cases not rise as much in that area, you could already see that we have herd immunity in some localized regions. That'll be the first step towards a return to normalcy. And then once we get a vaccine, we'll have a homogeneous kind of immunization to this virus. But I think we're clearly getting worse right now. I think in the next 6 to 12 months, this will be something that's behind us in my perspective. I guess one of the other interesting things about this virus, and something that I deal with, is that there's this big disconnect that's happening between what's happening in the real economy and what's happening in the stock market. The stock market's hitting new highs, and as we've just discussed, economic data seems to be rolling over as the virus is resurging. What's driven this disconnect, in my view, has been a combination of an extremely quick and sufficiently large response by both the Federal Reserve and Congress to the combined sum of nearly 50% of GDP. Can you discuss some of the more important policies that have been put in place and how they're driving your expectations for an economic recovery?
Yeah, I think from a big picture perspective, it's pretty amazing. All total hours worked in the U.S. fell by about 10% into the worst period of shutdown, which was back in April. And in the same period where total hours worked fell, total income, disposable income, which means income after all benefits and after all taxes, rose by 15% in the same. So it's as if hourly pay for 2 months of actual hours worked for the whole US rose by 25% at the same time. And really, all of the rich economies globally pulled this same trick off. And the way they did it was by getting their central banks to print money, and by getting their treasuries and finance ministries to issue debt. And I mean, basically, this borrowed money by the government flowed through banks to businesses to keep businesses alive, or to businesses in order to pay workers who maybe weren't working, or in direct checks. So in the U.S., some of the most important elements in the CARES Act was $1,200 checks for most individuals, and I'm sure some people on the call got those checks. Expanded unemployment insurance, so typically unemployment benefits, if you lose your jobs in most states for a number of weeks, you're going to get 30 to 50% of your normal income. In this case, you're getting 100% of the income. And really, it's those two things, the checks and the unemployment were the biggest things, but there was support for specific industries, and the Federal Reserve did all sorts of things. And I mean, the money printing is really the Fed buying bonds from financial market participants, which really leads to a form of money, electronic Fed Reserve balances that banks hold. And they did that too. And they can just basically type a keyboard, buy something, and the banks now have more of this form of money that they hold. These were the measures. Other countries did similar measures. The Fed also made all sorts of special changes supporting the market for corporate bonds, for mortgage bonds, for asset-backed securities, really creating liquidity in all these different assets. This is what has helped jumpstart the improvement in financial markets that we've seen since March. I'm sure everyone's heard there's been a very big increase in the stock market since the lows in March. But that improvement in the market has tracked the improvement in both, the initial surge in contagion, not the more recent one, and it has also tracked the shutdowns and the resumption of economic activity in a normal way. So if we look at high frequency measures of economic growth, the market does typically move with them. And we find that, April, May, things started to turn and the market moved a little bit ahead of that, and it's now going up. But high frequency means the stuff reflecting month to month, very short-term growth. And I think that stuff's going to peak around August, September. So this is a very short-term period, and it's like you flick the light switch. You turn the economy off, you turn the economy back on. People look at the data. First, it's really bad. Obviously, we're all at home. And then 3 or 4 months later, hey, the data's getting better. Well, obviously, because some of us have gone back to work. But sometimes the markets do move off of things that simple. And when there's meaningful policy intervention, on top of that, then there's another story. Markets move off narratives. So one narrative is, hey, the data's getting better. One narrative is, hey, we're going to have a vaccine in 6 to 12 months, so this isn't going to last forever. And another narrative is, hey, they're printing money and borrowing money, and that always leads to inflation, right? And so things will go up, and that's a question that we should probably go into. What are the implications of that? I described it almost as a chain where the Federal Reserve prints money, the government borrows money, it flows through banks into firms to households. Households have high deposits right now. Savings by most households have been high recently from those who have kept their jobs, and especially for even those who've lost their jobs, but they've gotten so many benefits and they've been sitting at home that they've been able to actually save a little bit of money through this. And we actually see that in the data, that savings is very high. But this is temporary, related to these policy measures. The special unemployment insurance actually runs out on July 31st, and there's hope that Congress actually gets through a new stimulus plan so that doesn't end, because the unemployment rate right now is still sitting above 12%, and that's a lot of missing income if those people are only going to get 30 to 50% of what they were getting 6 months ago, and that's actually 12% of the workforce. So the government has caused pay to rise and to be temporarily divorced from activity, and they've done this by causing basically government debt, central bank money printing, bank credit, bank loans and total bank deposits in the country all to increase. And this is a kind of war finance trick. This is what you do during World War II or a period like that. So now you're looking at it and, well, the economy's not fixed. So do we need more? That's the short-term question. And then longer term, what are the implications of all this debt, all this money, all this Fed action? What is that? These are actually separate questions. And it just shows how complicated and unprecedented some of these interventions are.
So I wanted to go into some of those questions. So one of the things when I think about all of the stimulus that's been done by the federal government, it's really about filling a hole, like the hole that the pandemic's created in the economy, not so much stimulating growth.
Yeah.
And so as we emerge, it's going to be pretty clear that there's large swaths of the economy that have been severely impacted and in some cases severely or permanently impaired. And so the US government's already committed all these resources to avoid a depression, but it seems like we need more to get us back to strong, sustainable growth. What is the potential for new policy measures that the government can implement? And what do you think the impact will be on the economy with those new measures?
Yeah, well, the first one is this debate on a potential next stimulus bill. Right now, Congress is in recess, so I think they return on July 20th. And to get something through, you'll need the Senate Republicans, as they control the Senate, led by Mitch McConnell. You'll need the House Democrats, they control the House, and they're led by Nancy Pelosi. And they'll need the president to sign off on new legislation. So three very different groups that you have to get together. And the White House itself doesn't always agree with itself on what it wants to do on some of these things. But the observation that the incomes, the cash flows of a large part of the household sector are really going to plunge in August is something everyone knows. And therefore, we know that it's important that they do something. So there's different proposals. So some on the Republican side prefer not to expand the unemployment benefits in the same way. They think that's paying people not to work. Some would send the checks out again. The president has, I think, hinted that maybe he would favor sending these checks out again. But if you're the House Democrats, do you want to authorize that right before an election? So I don't know exactly what shape this stimulus bill will take, but my view is that there will be a stimulus bill. It will get through. I think certainly the House Democrats have some leverage to allow them to have a say in what's in it and how it gets through. But I expect it to include something for unemployed workers, even if it's a stimulus if they get rehired, which is one of the things being discussed, or some kind of payment to firms that hire back their former workers. So these are some of the things being discussed. Then you have the Fed. The Fed right now has done a lot. I mean, they're supporting all sorts of markets. I think that they're not poised to announce, some major new program in the near future, but they're discussing something which is very interesting and historic if they do it, called yield curve control, which is where they set a longer term interest rate. So everyone knows that the Fed sets short-term overnight money interest rates. But it is possible for them to say, we're going to set the 5-year interest rate on government bonds or the 10-year interest rate. And internationally, a lot of countries have actually done that recently, most notably Japan. And there's been another version recently that Australia has used. And I think what the Fed might end up doing if things are difficult still towards the end of this year might mimic that Australian yield curve control. And in that situation, they set a yield, but it's not a very long-term yield. So they set maybe the 3-year yield or the 5-year yield, and they give an amount of time after which they would reconsider the policy. So they say, we're going to keep the 3-year interest rate around this certain level for a certain period of time, 2 years, something like that. So this is something they're considering. It's not clear that they'll do this, But this is the next big measure from the Fed. And the important thing on this for financial markets is if they actually set this yield, then the yield doesn't go up and down. As usual, people don't trade it. And that really matters for how markets, operate.
So I've been thinking a lot about the potential future policy initiatives by both the federal government and the Fed. I struggle to believe that the Fed is going to act outside of a big shock to the economy again. It just seems very clear to me, given the political environment we're in, that a lot of what the Fed is doing is really benefiting the wealthy and it's not really flowing through to Main Street. And I feel like if they go further, they're going to have a problem with the wealthy just keep getting richer because stocks just keep moving higher by things like yield control and some of the other measures that they're doing to try to stabilize financial markets. The average person on the street hasn't really benefited. And I feel like they go another step further, it's going to become more of an issue. And then when you step back and you think about, especially if there's a blue wave and Biden and the House or the Senate turns Democrat, this is like a once in a lifetime opportunity to do a major infrastructure bill. Biden had his economic policy today. I went through it briefly and it looks like there wasn't any major infrastructure plan in it. But when you think about where interest rates are at generational lows, the amount of the investments that we need in infrastructure, clean energy and whatnot, that there's no better time in the history of the United States to go on down that path and do some kind of fiscal stimulus. I don't know if it's interesting, and this is one of the other things I wanted to talk about related to where we are on interest rates and the level of debt, that there are substantial amounts of money coming into this pandemic to fight this pandemic. We're on track to generate a fiscal deficit of over $4 trillion this year. Total government debt to GDP will breach 100%, close to where we were in World War II. Interestingly, the actual interest expense relative to GDP is not near its peak because rates are so low. But when you think about the US is in a very fortunate position of having the reserve currency of the world, having essentially the central bank of the world, we have the ability to do these things. And the question is, one, should we do them? And then two, if we do go down this path of infrastructure, and we have to raise a lot of new debt to fund it, what are the longer term implications for interest rates, inflation in the US?
Well, let me back up a little bit on infrastructure. I think the argument that we have exceptionally low interest rates, infrastructure is a long-term project. And so if you have very low long-term interest rates and you can fund it, great. And I think it's clear that infrastructure boosts the productivity for the economy, so it's good for long-term growth. The problem with infrastructure, there's two problems with infrastructure. One is that it actually takes a long time to get going. So if the immediate problem in the pandemic is a cash flow crunch hitting now, that would have been extreme were it not for the measures that we've already had. Authorizing infrastructure spending next month doesn't solve that. It's likely that a vaccine is available by the time there are shovels in the ground for a major infrastructure project. So it's essentially a pro-cyclical policy stimulus if you're doing it this time. It's a strategic thing to do. And you know, the other thing I would say is that the politics of it are often a little bit different from what the public perceives. You know, basically, I think the Democrats have been in favor of infrastructure all along. I think the president has been in favor of infrastructure all along. I think a lot of Republicans in the House have not. Yeah. And sometimes I think people who follow it closely are aware of that. But you know, because it always like sounds great, I support infrastructure. You know, they're not always very loud about that. But when it comes down to it, the votes aren't there. And I think that's important. And when you're looking after the next election, neither party is going to have 660 senators, which means whoever wins, you know, they're not going to have a filibuster-proof majority in the Senate, which limits some of the legislation that they can get through. It doesn't mean an infrastructure bill is impossible, but it means that even if there's a Democratic sweep, they're going to have 51 senators, not 60. And the only way they're going to get infrastructure done is through a budget reconciliation bill. And in that case, where really they're going to get one major piece of legislation through per year, and that's through budget reconciliation. They kind of have to choose their priorities, and whether infrastructure will be priority number one is an open question. So I would distinguish between the short-term pandemic relief cash flow problem and the long-term opportunity to take advantage of low rates by doing some of the needed infrastructure in this country. And on that latter topic, I think the precise composition of the government will really matter. Now, that said, at one point, the Democrats proposed for the next stimulus round a $3 trillion stimulus. The Senate Republicans, I think, were talking about a $1 trillion stimulus. At some point,
Trump wanted two.
Right. Someone from the White House said two, which it sounds like they can average things well. So these are big numbers. I mean, another problem, the fiscal problem the government has right now is a big shortfall in state revenue, which is causing cuts in education budgets and state universities and things like that. But if you actually look at the numbers, it's not $100 billion. It's less than that. So if you're talking about a $1 trillion bill, you can do something on unemployment. You can do something on helping states. You could do something on some specific industries that you want to help. There's some talk of help for restaurants, for example. And there's probably room for some infrastructure as well. And the president himself may push very hard to make sure infrastructure gets done so that, so it's on his watch. So it can be done. Maybe it'll get done next month, something like it. But I think it's not pandemic, and I think it takes a little longer.
What do you think are some of the implications for the level of debt, though? Do you think that this will ultimately drive inflation once we have a vaccine and the virus is behind us? Or are we going to be still stuck in the world that we've been living in the past 10 years of low growth, low inflation, just kind of too much capacity in various industries where we can't seem to invest in projects that drive real productivity?
Yeah, well, I think of inflation as being driven by forward-looking things, expectations. And when you get, when people think that prices are going to be higher in the future, you want to buy the car now because in 6 months it's going to cost more. You want to invest now. You want to build up your inventories if you're a business now because, this is financially advantageous to you. In the last 20, 25 years, inflation's been incredibly steady. I would argue that it hasn't been very low. I mean, average core inflation in the U.S. has been 1.7% since 1995, and it's never really gotten very far from that, including after 2008, and we're still there. So, I think the question is, are we now in a situation where we've had such a big shock that it can dislodge us from this very calm inflation, which isn't very correlated with whatever happened last year, and doesn't seem to be a situation where households and businesses are even considering inflation when they're making spending decisions? Can we get out of that? And if we get out of that, like good, calm inflation regime, which way do we go? Do we go towards an inflationary regime, which we haven't seen for a really long time, or a low inflation or a deflationary regime? And we have the examples of Europe and Japan in the last 25 years, which after respective shocks had their inflation rate pivot lower, then go sideways again, but at a permanently lower level that they were never happy with. And I actually think that the pandemic has raised the risks of both scenarios. It's raised the risks of higher inflation. It's raised the risk of a drop. And I think that no one should say the stock of bank deposits or the size of the Fed's balance sheet or the size of Treasury debt has gone up, and therefore they can answer the question, and inflation is going to be higher. Not the right way to do it, because inflation is about the interaction of households and banks and businesses, their expectations about the future, and policymakers. And the Fed gets to sit back and observe all this and respond. So even if in 2 years from now, there's a strong recovery and inflation is going up a lot and it overshoots 2%, the Fed can say, all right, economy is recovering, time to raise interest rates. And if they raise interest rates enough, it will slow the economy and that will likely get inflation down. So, we should not, basically to say that we're going to have sustained high inflation now is to presume that that the Federal Reserve will tolerate it 2 or 3 years in the future without knowing really where the pandemic is going, how much further damage there's going to be done, who's going to be the president, who's going to be leading the Fed in 2 or 3 years. Basically, the economy just doesn't work where you can look at the debt and the money levels now and it tells you where inflation is going to be several years out. I don't think it's that bad. But again, I think there's a scenario, there's a case, you mentioned the government debt, where the government says, well, we have a lot of debt, we have to pay interest on that debt, that interest is low. If inflation starts to rise, well, then the interest has to rise. Well, then guess what? Then the debt costs have to rise. And that if you raise interest rates, you're gonna damage some business, you're gonna hurt the economy. You're also gonna drive up the government's debt costs. So the government can say, well, actually, we don't really wanna raise interest rates because not only does it hurt the business sector, it hurts us. So why do we do it? So they don't do it. That's how you get inflation. So that could happen, but it should not be seen as an inevitable implication of everything that's happened so far.
So when you think about that, you feel like it's equally likely we can go to a higher level or a lower level. What are the things that are in your mind the most important to determining where we go, and what are the things that we should be watching for?
Well, I didn't say it's equally likely. I think the probability of each scenario has gone up, and I would think about the sequencing. I think in the next 18 months, it's far more likely that we have low inflation. We've already seen inflation fall, and the economy is not in a genuine recovery yet. The economy is just seeing some better data because the lights have been turned back on in a lot of businesses. So we're going to have low inflation for a while. After that, we're going to have a rebound. So the question is the rebound going to be sufficient to get us back to the old level and above? That's a much harder question. So the deflation, disinflation, low inflation, we're having it now, we're going to have it for a while. The inflation question is a little bit harder. And it's very interesting. In my role, I talk to a lot of bonds people and a lot of stock people, and they have very different views on this. And the equity market people tend to focus on the money and the central bank and the debt and say, look, we're clearly going to have inflation. Well, if you own a lot of equities, that's pretty good for you. The bond people tend not to think that way. So, again, I think we know a lot about the low inflation that we're going to see in the near term. We don't know a lot about the high inflation that we could see later on. We do know about potential forces that could get us there. So that's the way I would put that. I don't know if I just answered your question or not.
Yeah.
Okay.
So and kind of along that is one of the themes that I've been focused a lot in our portfolio is this idea of technology as unlocking capacity across sectors, whether it's streaming music, the shale energy revolution, or one of my favorite things to talk about is that's really inefficient, and digital matching platforms that are pairing freight with the right load at the right time, where like the current environment or the current process is you're a truck, you call someone up on the phone and say, I need a load to go from X to Y. The guy finds it eventually, but it's not an efficient process where there's an app now that you can match the load, that it knows where your truck is, it knows where you're going to the next stops, and it can fill your truck the most efficient way, where the drivers paid the same amount, but the cost of shipping the freight is down 40% and everyone's better off. There's just mass inefficiency in the system, and we're seeing all of this money funding companies that are disrupting traditional ways of doing business and crossing the chasm faster than they would have in a higher interest rate environment. And with this pandemic, something that we were talking about, Jeannie was asking me before, one of the things that you're seeing is we're kind of living in the future right now. The trends that we expected over the next 5 to 10 years has been pulled forward 5 years. And you're seeing adoption of digital tools such as Zoom that we're doing now. And that has a lot of implications for growth and inflation in the future. And so I wanted to get your views on the improvement in productivity that we're possibly getting from these digital tools and all these other productivity initiatives that companies are really being forced to undertake as we work from home, what are the implications of some of these things?
Yeah, I think it's very important, and I would separate short-term and long-term. And short-term, it might actually cause some troubles. So one of the major challenges that the economy faces is basically getting the unemployment rate back down, getting people reemployed. And one reason why that might not happen quickly is that a lot of businesses are damaged. Their earnings have been very weak. There's some businesses that are even closing from this. And so those jobs are not going to be there, let's say 6 months from now, even if the virus is under better control. But another issue is that when a business sees that a lot of other businesses are doing badly, or when a business sees that there's a virus around and therefore their customers aren't coming in, they don't expect a lot of sales. They don't expect a lot of customers. They're going to hire fewer people. That's a forward-looking thing. And then a third thing is what you're talking about, efficiency gains. So what's just happened in the past 4 months is that we've all learned how to use Zoom. We've all learned how to use a lot of new technologies, and we've found out some things. I mean, in our industry, in the financial services industry, a lot of the firms have been shocked that they've sent everybody home and things are actually working fine. They've learned that actually these businesses can function like this. And in some ways, it's even better. And I think some firms are going to take advantage of that by saying, all right, you know what, we can cut some costs. Maybe we need fewer workers if we're doing this. Maybe we need less space. Actually, a sector where this is very important is healthcare. Healthcare is 16% of US GDP. And one of the things we just found out is that doing these kinds of Zoom calls work for a lot of doctor visits. And that means a lot of jobs and a lot of real estate that sector uses might not be necessary because you can have these efficiency gains. So this might slow the return to full employment in the economy. Longer term, though, for a lot of businesses, it will help them make the same kind of money with fewer costs. So it will add to their productivity. Whenever you add to productivity like that, it changes who's making money and who's not. Some workers win, some workers lose. Some investments go very sour, some go spectacularly well. So there's a lot of redistribution of who does well and who doesn't whenever you have a lot of turmoil in productivity. But from putting those distribution issues aside, you have a stronger economy when you're churning things and you're finding a more efficient allocation of your workers and your space, et cetera. I mean, what's happening in the retail sector is that, maybe there are fewer stores, but there are very efficient big warehouses, and we can sit at home and we can order things. And, we can get those sent to us directly. And that actually frees up a lot of time in our days. And so, this is just change. This is just flux in our daily life. Technology brings it, and the pandemic has, for now, accelerated it. So there are many implications, both short-term and further down the road.
I'd be curious to get your opinion. One of the things I've been thinking lately about this whole idea of pulling forward the future, I was meeting with L'Oreal, the cosmetics company. They had a great chart of showing their online sales as a percent of total. And over the past 10 years, it's kind of going up 1% a year.
Yeah.
So 16%, 17%, 18%. I think it was like 19% as of the end of 2019. In March, it jumps to 29%.
Yeah.
Right? We pulled forward 10 years of incremental growth in online penetration in 3 months. And I wonder if a lot of the disruption that's been going through the economy, this actually it makes the pain that you were kind of talking about, this redistribution of where investments goes, where jobs go, shorter, more painful in the short term, but also you get to the end point quicker. And is that something that you think is beneficial in terms of how disruptive it is, or is that something that it would have been better to kind of just move along at a pace that the economy can kind of accommodate?
That's a really hard question. It's different in different sectors. I mean, one of the like hypothetical versions of this would be, imagine you went to self-driving cars and trucks very, very quickly. And so that the population of paid drivers, which is a huge high employment industry, suddenly all those people lost their jobs at once. So you have a big efficiency gain in the economy, but it would not be optimal for all those people at once. And you would need government support, and you'd need special programs to help them. So this is a little fast. This is a little fast to jump to this new situation. I mean, I think it's different by sector. I think if the healthcare sector wants to use less real estate, they have long-term leases for the most part. That's going to naturally slow their process. I mean, if financial firms are going to, have a smaller physical footprint, that also is going to take time. So I think there are some natural forces that are going to slow some of these things. I think although it feels very abrupt and pandemic-like, I would expect that their online sales are going to fall. They're not going to go back to 19, but they're going to fall. I mean, what we're seeing, I've seen a lot of data on this too. Foot traffic in anything, obviously way down. Web traffic in the same thing, way up. And that's a pandemic situation. So, but there's a long-term trend in both. And so, foot traffic will be down less, and web traffic, or foot traffic will rebound some. Web traffic will come down a little bit, and there will be disruptions. But it's kind of hard to say on net, good thing, bad thing. It's just, this is what we live with in terms with the constant change in our economy. We've been living with it for 200 years.
So I just wanted to remind the audience that you can submit questions, and I've already gotten a few, so I'm going to turn to some of the audience questions. So the first one is, how do you assess the future military and economic relationship between China and the U.S., and might a potential November U.S. leadership change affect this relationship?
Yeah, well, the president himself tends to make dramatic decisions. And capture a lot of the spotlight, a lot of the public attention on U.S.-China relations. But I think it's important to point out that the attitude towards China has changed in a broader bipartisan basis in recent years. A democratic government would be a lot tougher on China than past democratic governments. And so I actually think that there are going to be some tensions between the U.S. and China, regardless of who wins the election. There will be tactical differences. Those tariffs, the way the tariff situation was handled, the average tariff, China exports over $500 billion in goods to the U.S. and the world. It's the biggest flow of trade in the world. And about 3 years ago, the average tariff rate on that $500 billion was 3%. And, by last August, it seems a million years ago now, but last August, that tariff rate was at 15%. It had recently gone up in May, a few months before, and the president didn't like the way the Chinese were following through in some things they said, and he raised the rate from 15% to 26%. And that was going to take effect between September and December. And that really scared financial markets to the point where the White House dialed back these tariffs, and we ended up ending the year with a deal that left these tariffs around 18, 19%. They're still above 15, but they're far above. This is a very volatile way of handling the world's biggest trade relationship. I don't think the Democrats would disown using tariffs as a foreign policy tool. And there are many things China has done which with Democrats will be unhappy with. So you may have high tariffs, but I don't expect tariff rates for that to be swinging around by 10 or 5 percentage points at a time. So it's going to be different, but the tensions are not going to go.
So kind of related to China, clearly one of the, and I think it's a bipartisan issue of focusing on technology transfer and just general IP transfer from US companies to China, which I think is a very valid argument to make. It seems like the pandemic is maybe accelerating the idea of having separate technology stacks, having separate supply chains. Really, there's a focus of national supply, not international. So it seems like the trend of globalization has been breaking down over the past few years, and it seems like it's accelerating, particularly with China. What are the implications in your view to global growth, and really what are the implications for the US in terms of reshoring some of this manufacturing, whether it's pharmaceuticals or maintaining technology IP in-house? What do you think that does to supply chains and global growth in general?
Yeah, well, so China's share of physical production globally, its share of global industrial production in 2000 was 5% and is now around 30%. Which means they went from producing 5% of the world's stuff, not services, goods only, to 30 in 20 years. And they did that a lot of different ways. Some ways totally legitimate, some ways that make others unhappy. And I think the pandemic has highlighted that there are certain vulnerabilities that a country has if some very needed goods are produced elsewhere in some place which is not one of your tightest allies, and that is making it very important to make sure certain production is here. And you're seeing some developments like in the semiconductor industry, and I think you'll see some developments in the pharmaceutical industry that are in response to this. However, this story does tend to run a little bit ahead of itself, because people then jump to the end of globalization or things like that. And the reality is China built those factories for 20 years. They were expensive to build. They required a lot of work and a lot of effort, and they were done in a financial system which is very different from ours, which means that it wasn't always a profit motive that was making these things happen. In this country, things often, usually, are driven by a profit motive. And I don't really see how a profit motive is going to get, millions of factories built in the US, employing a large share of the US population, and firms seeing a giant financial opportunity that maybe they don't want to invest in technology. They want to build a factory to basically beat China's market share in some specific product. It's not going to happen on a scale that's going to get China's share from 30% back to something much, much lower. So, there's a lot of different elements to this, increasingly rivalrous relationship.
I agree with that. And I agree that whether we have the current president staying in office or the Democratic nominee elected, the rhetoric against China is not going away. I think the cat's kind of out of the bag, and it's a near unanimous opinion that something needs to be done, not necessarily to limit the rise of China, right? They're a big economy that's growing, but to play by fair rules. And I think this is something that we're going to be living with for quite a while.
Yes.
Another question from the audience. This is shifting topics. Would you be interested, would you be invested in fixed income with interest rates at such low levels? And a second question is, if so, what segments are constructive?
All right, well, maybe. I mean, I think, why, let me put it this way. Why might you want to invest in fixed income at these levels? Well, first of all, it diversifies your portfolio. And so we know the equity market can go down a lot, and a lot of the fixed income market tends not to go down a lot. So for protection of your portfolio, bonds make sense even when interest rates are so low that you're giving away a lot of upside. That's the basic reason. So if you're thinking about your broad asset classes, cash, property, equity, fixed income, the fixed income, a lot of investors' primary argument for owning fixed income is not yield. It's correlation, and it's diversification. And it's often liquidity also, the ability to sell your bonds quickly and raise the cash if you need to without causing the price to move. I mean, for instance, if you have a house and you want to sell it in a week, you're likely to get a very bad deal. In the bond market, you can probably sell it at whatever the price is very quickly, and the price doesn't care about your selling it. So I think, I mean, those are very basic reasons, but I think, it is, major investors generally back having a balanced asset allocation with a decent share of fixed income, and low yields do not necessarily change that equation. And also, on some measures, equity markets look quite overvalued right now. Not on all measures, but it is true that in general, when people forecast future earnings for the stock market, and you kind of turn a stock into a bond and you say, well, what is the yield that the stock is likely to get? Stocks come out looking pretty good right now relative to the low yields that exist. And that's probably the most sophisticated macroeconomic reason that you'll hear from professional investors on why they're buying stocks now while they're going up in the middle of a pandemic.
Yeah, we're debating that a lot. When you think about the stocks that are going up, it's the stocks that have actually seen growth rates accelerate. And so if you think about a simple way of valuing a company, it's the free cash flow divided by the required return you have less the growth rate. And if you think about where rates have gone, they're at zero. And for some of the biggest companies in the world that are natural monopolies, like a Facebook or Google or Amazon, their growth rates have actually accelerated. And when you compare them to bonds, as you said, they actually still look cheap despite how fast they run in a pandemic. And actually, that's why you see companies, or not investors, but public equity investors piling into these growth companies as they've gotten more attractive during the pandemic, not less attractive. And they tend to be the biggest companies in these indexes. So I think one of the indexes that a lot of investors benchmark against is the Russell 1000. And I think in October, when they reconstitute the index, 40% of the market cap of that index is going to be the top 5 companies. Your Microsoft, that's 1.6 trillion. Apple, that's 1.4 trillion. Amazon, that's 1.3. And so those companies have gotten more attractive in this environment, not necessarily because something's dramatically changed in their long-term outlook, but because interest rates have gone so low and short-term boosts to their growth rates have really increased the attractiveness to some of these, and it's just generating a lot of flow of money. So I think one of the biggest debates that we're talking about is what happens when we have a vaccine and the virus goes away. I think a lot of the attractiveness of those growth stocks go away, and then you have actually probably less attractive fixed income, because that could mean that rates start to rise again. Not necessarily because of inflation, but just because of a lot of the artificial measures that have been put in place.
Yeah.
Go ahead.
I do think unemployment can be very slow to fall, and one way monetary policy helps unemployment fall beyond the obvious, like risky assets, stocks go up with low rates, is by supporting long-term low rates. Right now, you can get a 30-year fixed rate mortgage for not much higher than 3%. And I think that as long as the unemployment rate is well above 5 or 6%, I don't expect the Fed to look kindly on anything that leads to a sharp increase in long-term mortgage rates. So I think even if they go to yield curve control, they may continue to have an open mind about purchases in the event of moves that imperil the mortgage market.
So here's another question. With the probability of this COVID situation lasting another 6 to 8 months with the resurgence that we're seeing, what is your thoughts of when people start to panic and taking out cash? And do you think it'll happen? I've heard of a few clients recently saying they're thinking of changing their investments into cash.
Well, we've seen it already. And in fact, when we look at the Fed's balance sheet every day, and actual cash in circulation in the economy has risen sharply. So a lot of people during the worst part of the pandemic, especially early on, literally did go to the ATM and take out a bunch of money and stuck it under a sofa somewhere. It's not so big that you would necessarily worry about it. What the Fed has done with the bank reserves is much larger. But there has been a very significant increase in the supply of cash in the economy, and there's no sign that that supply is something that people don't want to hold. I mean, ultimately, one of the things that determines how much cash people are willing to hold is how much they're compensated for holding bonds. So if interest rates are very low, then sure, hold cash. Why not? You know, with cash, with a bank account, you're going to get an interest rate that is basically floating. So if inflation goes up, floating interest rate will track it, and you're actually hedged on inflation. With fixed income securities, inflation is basically a tax on your security. So the demand for cash has gone up. I mean, in an extreme case, when interest rates are really low all the way out, like close to zero, and you know, you can have a situation where you're printing money and you're giving people money, and they see no interest in buying a bond that's not yielding much more than the money, and so they just heap the cash. And you know, we call that a liquidity trap. It's something Keynes wrote about, and that's not a place you want to be. And we're not there. But some of the things you've seen in Japan in recent years, for example, are not very, very different. So yes, cash is not that unattractive. It's not a bad thing necessarily to have cash, but it is a place to hide, and you're hiding from some of the inflationary risks from bonds. You're you know, basically vetoing the low yields that bonds are offering, but you're also, of course, avoiding some of the volatility that you can have in stocks and picking up some of the diversification benefits that bonds offer.
I also think that just with the Fed backstopping the financial markets, I don't think you necessarily have to panic. It's very clear that they're willing to react and react quickly and of sufficient size to stabilize whatever financial markets you have.
Yeah.
I think, like, when I think about what the Fed is doing, he's systemically, or the Fed chair was a she last time, systemically kind of making markets uninvestable and squeezing people more and more into riskier investments. So I think the biggest risk is, for me, when I think about it, investing in public equities, is when that stops and starts to reverse. But I don't think there's necessarily a panic to think you have to get in cash, given the backstop that the Fed is providing right now to the overall financial markets.
Yeah.
One of the questions I had, you touched on it briefly, and I'd be curious if you've done any work on, is there going to be a structurally different slope in the pace of the unemployment rate coming down? One of the things that's very different about this recession relative to prior recessions, whether it's the global financial crisis, a lot of the unemployment's furloughed. There's a question of when those furloughs become permanent employees and the level of attach they have to their firms, or the strings that they still have to them. Is there a reason to think that as we get out of the pandemic and once we have a vaccine, that we snap back quickly from an unemployment rate, or it's actually going to be a slower pace of recovery, given that this is a very different type of economic recession?
Right. Well, I would distinguish the shutdown and reopening phase of this and what that does to the jobs data, including the unemployment rate, versus what happens after that. Because a lot of the initial increase in unemployment and job loss is really hourly workers being put on 0 hours. So if you're basically given 0 hours, you're technically unemployed. You're eligible for benefits, and your boss may be saying, look, we're going to reopen the shop or the restaurant as soon as we can, and you're the first person I'm going to call, and I want you back. According to the government statistics, you're unemployed. But so, as long as those stores and those restaurants reopen, those people are going to get their jobs back. So these crazy numbers, 20 million plus, or unemployment rate going to 15%, and these things, this is the shutdown. This is the light switch going off in the economy, turning back on. So certainly there's a precipitous phase of unemployment falling, which really just reflects turning back on. But where will unemployment rate be when that phase is roughly over? And let's say that's over late this year, early next year. And my view is that unemployment rate is going to be pretty high. So to put it in context, in January of this year, the unemployment rate was 3.5%. The worst point during the 2008-2009 recession, it was 10. So I think it might be 8 to 10, even when the pandemic is under control and the shutdowns are over. And at that point, it will likely still be falling. But then the question is, first, why is it so high, and what's the rate at which it falls? And I think it will be high. I said earlier, because there's backward-looking damage, because forward-looking sales expectations are limited, and because there's a bunch of efficiency gains that businesses are taking advantage of, which temporarily reduce employment because they've realized they need fewer workers. Those people are out of work. They'll eventually find jobs because there's higher productivity and income in the economy, but it's going to take a little while. So you're stuck pretty high. And this is why I think that the Fed it may well do more, because they're going to say that this 8% unemployment or something is not good enough. They need to keep supporting it. They're going to see risks of lower inflation if that's the case. Then it really will start to fall in more of a trending way. And the history on this suggests something a little weird, which is that when the unemployment rate starts trending down, it tends to trend down at a pretty constant rate. So from 2010 until about 2015, it fell by about 85 basis points per year. And it really didn't swing around very much relative to that. Even though there were some big things happening, there was a Europe crisis, the market went up and down, but basically it went down in a straight line. I used to joke with people, and I would say my model for the unemployment rate is a ruler. I just put a ruler on the page and I can tell you where it will be in 2 years. And if you did that for about 6 years, it actually worked. And in past cycles, it hasn't been that different. So if it's 85 basis points a year, so it goes from 9 to 8.15 to whatever 8.15 minus 0.85 is. I can't do that in my head. For the next X years, that's not very good. That's a long time until we get back to 5%, and an extremely long time before we get back to 4 or 3.5. So hopefully it'll be a lot faster. And I think putting all this stimulus in the economy can help it along. Actually, your idea for infrastructure works in this context, because the infrastructure would likely be occurring while the unemployment rate is falling. You're trying to get it to fall a little bit faster, but hopefully we can get it to fall faster than 1% per year. And hopefully it starts this steady decline at a level, below 8%. And so then you're looking at 2-3 years before we get back to 5. And I think that would be a result that you take at this point.
So I have a few more questions, and I'll try to get to all of them quickly. The first is, and I could answer part of this, is what is your view if the vaccine takes longer to emerge than you anticipate? I would just start by saying we are going to have a vaccine. The question is, how effective is it? There's over 250 therapeutics, whether they're therapies to treat existing infections or vaccines to prevent infections. There's probably 4 to 8 high priority programs. Most of the early clinical data shows that they generate protective antibodies at levels of people that have been infected or higher. And so it's very clear that we have something that's effective. We don't necessarily know how long the protection will last, whether you need to get dosed, twice a year maybe, or once every 2 years. Does it last for, like some vaccines, over 5 years? We're going to have something. We don't necessarily know how safe it is. A couple of the leading vaccines use technology that's never been commercially developed for use in humans before, which is something that's interesting. I'm not personally going to try to get one of those vaccines. But I think there is going to be one. And I think we're likely to see, and I think it will be somewhat of a political thing, we might see a early signs of a vaccine being rolled out by around the election. The other thing that's risky about a vaccine, and why it usually takes 10 years to develop, is because you have this potential for a vaccine increasing your likelihood of having an infection. And I won't get into the mechanics of how that happens, and that's one of the reasons why it takes a decade. And so I think a vaccine will be rolled out slowly, and that's the benefit of having all of these vaccines, multiple vaccines. We can implement them in various parts of the population without risking choosing the wrong one once we find out that it may not necessarily immunize you, or it might make you more prone to having the infection. So I don't think there's really a question of, will it take longer to emerge? I think it's very clear that probably by the first quarter of next year, we'll have a view of what vaccines we're going to use and how quickly it'll be implemented. But it is a point that maybe it's a slower to roll out, and what are the risks that happen if it's a slow rollout of a vaccine?
Yeah, I agree. I think also, getting people to take it, I think is going to be an issue. The international supply of it is going to be a big issue. You mentioned herd immunity earlier. What's the interplay between what is the right level of herd immunity? I mean, I still hear some people say it's like 30% gets you there, which seems like a wild guess, but there's I guess a little bit of evidence in some places that maybe that could be true. So I think we do have to be a little intellectually humble about how all these things play together. But yeah, I'm hearing the same things, that basically this is a Q1 type story, at least here in the US. And also, I think very important point, that a lot of doses can be actually mass produced pretty quickly. Like that's likely that actually you could have 100 million doses of this, by the end of the first quarter. I don't know if that's consistent with what you've heard. But
no, I think we could have, for multiple different vaccines, over 100 million doses. I think the government's been, and goes back into that whole kind of globalism versus nationalism. The U.S. has been very effective through the HHS portion of the government by giving hundreds of millions of dollars to biotech companies to fund the development and the at-risk commercialization of these drugs, and we're getting first priority for them. So I think we have by far the greatest share on a global basis of all the leading therapeutics that are being developed. I think that's going to be an advantage for the U.S.
Yeah.
Next question is it right to assume we're going to see very large tax increases both nationally and locally, and how will that affect the recovery?
It's not right. I mean, you could see Biden actually, I think, has made some specific proposals on taxes. I think on the corporate tax, it's actually half of the Trump tax cut would rebound. I mean, the high end of the household tax rates have really been jumping around 33 to 39% for the last 25 years. So that may continue. But I don't think a wealth tax or extremely large tax is part of the Democratic platform right now. I don't think they would do it. I think you get some tax increases. But I think there's going to be, however, a significant push on tax collection, especially for multinational companies who are able to pay a lot less than their statutory tax. I think in general, the market, a lot of people have the view that, Democrats bad for business, Republicans good. I think of it more micro. I think clearly you're going to see a lot of the regulatory changes under Trump reversed, which is going to affect the fortunes of certain sectors. And again, if you say you're going to try to really fully collect the effective tax rate for each sector. For some sectors, it's fine, they pay it already. And this tends to be businesses that are onshore. For some of the sophisticated global sectors, they may be paying tiny taxes because they have all these things set up. I think there's going to be a real focus on going after that. So a little more micro, a little less macro in terms of the impact.
It's pretty clear in my world that people are starting to put increasing probabilities. One, with a blue wave with the Senate flipping and Biden becoming president, and two, corporate tax reform is going to be reversed somewhat. So not necessarily the personal income tax, but as James pointed out, the top tax bracket may fluctuate. But I think it's not crazy to assume that we go back several hundred basis points higher for corporate tax reform, particularly with the deficits that we're funding. It's something that we think about for a lot of companies, and I think, as you pointed out, that the clear targets really could be some of these web platforms, these natural monopolies that aren't paying their fair share, with a lot of income, hidden in Ireland and some of these other countries that have tax havens, as they're just generating so much wealth on really the coast, and they're not. It seems like an easy target to kind of extract some of this earned income from outside the country. Another question is, can you talk a little bit about the venture capital market? What changes do you see as a result of what's happening today?
Well, I mean, that market has been very, very hot in recent years. But actually, it's funded a lot of the tech companies that are precisely the winners of the pandemic. So not clear that the pandemic has been bad for that world. And for certain corners and certain specific companies, it's really highlighted the value in some of the new business models. So I think there's dispersion. I'm not, I go out there sometimes and talk to people in the venture capital world in California. But I'm not an expert, but I do think that, there's a lot of companies that have really seen their business leapfrog forward in line with some of the remarks we had earlier on productivity because of this. But it is also a sector where valuations were very extreme in some cases. And, so I'm sure there's some turbulence and there will be some failed businesses as we go through this.
It seems to me that given, the expectations we talked about, inflation still being relatively low, that's one of the drivers for putting money in these venture capitals to find these startups, which is interesting. It creates this vicious circle where lower rates drives more investment into these private startups to get a return that are disrupting more of the economy, that then generates more disinflation. It's just this cycle that keeps happening. And I don't see the pandemic necessarily changing that. We saw with I'm sure everyone read about the issues that WeWork had and the lack of profitability from some of these startups. And so I think maybe the focus on how these businesses run changes, and the metrics that these private capital or venture capital businesses are focused on changes. But I don't think, if we're in this low rate environment, changes where the money's going. And it seems like there's still a long runway for investment in these private assets. But valuations have also come down, to your point. The next question would be, would you expect stagflation like the 1970s, given the possibility of an extended period of creative destruction and higher inflation in necessities like food?
No, I would not expect that. I think, we may have a period of higher inflation in a couple of years as we rebound, and if the Fed is slow to respond. But in the 70s, the core of the shock especially during the oil price jump in 1973 was a negative productivity shock. And the Federal Reserve was responding to the inflation at the time by really not responding adequately. So, and that actually caused inflation to keep kind of ratcheting up higher and higher, and it caused a lot of pain. And really inflation started to drift up in the mid-60s. The big jump was in 1973 after the Yom Kippur War, but really this didn't end until 10 years later with Paul Volcker's monetary policy. And central banks have learned from that how to control an inflationary outcome and how to think about it. So the two big differences are first, central banks know what to do. And second, based on what the two of us are saying right now, this might actually be a positive productivity shock rather than a negative probability shock. But where we can be wrong is that the unemployment rate may be very slow to recover, and as I said, that's consistent with what we're saying broadly. But inflation can overshoot with a slowly declining unemployment rate, and the Fed can get it wrong, and they can allow inflation to go. But that's the main point. Don't start with money has gone up and the Fed balance sheet has gone up and government debt has gone up, and therefore there's going to be inflation. Realize that actually first there's going to be low inflation. Inflation is probably and hopefully going to rise later. And then there is some state of the world where the central bank doesn't actually react in the right way to keep it on the right level. They know how to react in the right way, but maybe they're afraid of government debt costs going up. Maybe whoever the president at the time is pressuring them. Maybe we have different Fed leadership and they're very radical. And those are all states of the world that are possible. But to sit here now and to say that will happen is a little bit of a stretch.
So I have just one more question before we have to close from the audience. And as a small business and as small businesses and restaurants continue to close over the next few months, as well as some of the largest chains such as JCPenney's and others, how will this affect the market?
Well, the market understands that this is happening, first of all. So I don't think the market is necessarily going to get new information from the lagged implications of the shutdown that happened. That's in the price now. The issue is the economy able to adjust for these changes quickly enough so that we're back on our feet? We know that some of those retail establishments had business models that are suffering in a world where consumer habits and preferences have changed and more shopping is done online. And so the pandemic is a catalyst to move that along. The question is, can we reabsorb those workers? Can we create new businesses and new jobs fast enough? And that's tough. And I've argued that it's going to be a number of years before we get unemployment back down. Financial markets know this already. But if the business failures turn out to be substantially worse than expected and unemployment is even higher or on a even worse trajectory than I've laid out, then the market will respond to that negatively. The Federal Reserve will likely respond to that with new policy measures. So, it's a complicated symphony that we're always forecasting, and we're watching all these things move together. But there is an expectation of ongoing high business failures and bankruptcies right now, and that's precisely why all these policy measures are occurring.
So I think, just to summarize, I think the discussion we've had, it's actually, while there's uncertainty now over the next 3 to 6 months, I think we have visibility finally to an end to this pandemic, as well as positive government policies that are stabilizing the economy to a level that we don't have a depression, and we can see the light at the end of the tunnel, and we're seeing more good times than bad over the next. In a year from now, we wouldn't be talking about the things we're talking about, is my guess, and I think we both agree on that. Jeannie, I think we've hit time, so I don't know if you'd like to close or have any remarks, but thank you for having both of us here today.
Well, I'm excited. The information that we got today was amazing, and I hope everybody appreciated it. I'd like to thank you, Neville. You were phenomenal. You kept the program going like a pro that you are. So thank you very much. I'd like to thank my son, James, for sharing your gifts, because you are the smartest person I know, even on prejudice. I'd like to thank our sponsors, Theo Etzel, Chairman of the Board of Conditionaire, Michael Wynn, President of Sunshine Ace Hardware, Connie Ramos-Williams, President and CMO of Conrac PR and Marketing, Brian Riss, Executive Chairman of StormSmart, Kevin Lorraine, President and Chief Executive of Quest Resources and our next County Commissioner, and Scott Lehman, President of Trinity Janitorial Service, and Javier Fuller, who is we call him our Wizard of Oz. It's always in the back, and he works with Conrad PR and Marketing. He is our Vice President of websites, and he is phenomenal. And Connie, we cannot thank you enough for helping us put this program together. So on behalf of the Above Board Chamber, I'd like to thank each one of you for doing a phenomenal job. Our next program that will be coming up will be on creating diversity in the workplace, which is a good thing. We all need to learn what's going on in our communities and our environment right now. So thank you again for coming. Each person that's listening to this program today will be given a copy of it probably within an hour or so. So on behalf of the Above Board Chamber, thank you, everyone.
Thank you.
Thank you.